Hello and welcome to 5 Things Investors Need to Know This Month. I'm Valerie Leonard, CEO and founder of EverThrive Financial Group. Today is Thursday, September 19th, and let's dive straight into what investors need to know for the month of September. First of all, let's talk about rate cuts. You probably have already seen in the headlines that the Federal Reserve met this week and decided to cut rates by 0.5%, which the market has largely seen sort of like the Fed was panicking because the economy is slowing. The market itself had priced in about 0.25% rate cut. And so the 0.5% cut was surprising, and it didn't exactly indicate that the Fed is confident about prospects for economic growth going forward. As a reminder, the Fed has basically two jobs. One is keeping inflation in check, and then the other is making sure we have a strong jobs market. And the Fed's focus for years now has been on taming inflation, but now that economic data has slowed, we expect more rate cuts later this year and into 2025. If you look more closely at what's actually happening, though, we're seeing the Fed devalue the US dollar and inflation is actually starting to pick back up again. I don't know that it'll be seen in headline numbers until later this year, but it's definitely going to be something to watch closely going forward. Second, this month, we're keeping a very close eye on the labor market. Since this time last year, layoffs in the US have increased about 1%, which may seem like a low number until you actually put that into context. In the month of August, we saw the highest number of layoffs since 2009, if you exclude August of 2020, which is when, of course, we saw pandemic era layoffs. Employers are naming AI as one of the primary reasons for job cuts. And at the same time, new hiring is at its lowest total since 2005. The technology space has been particularly hit hard, as you can see from this graph here. It shows tech employee layoffs from October 2023 until September 5th of this month. And the yellow arrow is pointing, of course, to the month of August. So the bottom line is that the labor market is still strong, but it has weakened a good bit. Third, after a correction in the NASDAQ last month, it wasn't really surprising that we saw a shift from technology stocks to other areas like consumer staples, utilities, and even healthcare. And some of this may have been driven by the upcoming election, but it still bears watching. One note, when you look at the NASDAQ over a 44-year period, the index has experienced a correction after it's hit new highs 24 times, which is about once every 2 years. In about two-thirds of these instances, the data shows that the index traded higher a month after entering correction territory. Of course, past performance is no guarantee of what we might see next, but we have seen historical patterns in NASDAQ swings. So, having said this, the NASDAQ is still showing a bullish trend, and tech has the potential to benefit from slowing economic growth in combination with accelerating inflation, as do some other areas as well, like emerging markets, gold, and perhaps some other commodities. So, this is going to be interesting to watch. Fourth, we're seeing solid fundamental and technical factors as we head into fall months. Technical factors still point to a strong bull market trend from a broad index perspective, as you can see in this 2-year look back at the S&P 500. And despite recent volatility that we've seen, the positive trend is, of course, still intact for now, and the S&P 500 is nearing all-time highs again. From a fundamental perspective, we saw impressive earnings growth in the month of August. The average growth rate for companies in the S&P 500 in the second quarter was 14%. And consumer confidence has also improved. We saw stronger consumer confidence survey results than what we saw in July. There have been some strength in both international markets and emerging markets this year as well. Countries like India, the Netherlands, Ireland, Italy, Japan, the UK, these are all areas that have seen strong returns among other countries as well. And then finally, we saw some strength in the service sector. And this is important since the service sector employs nearly 90% of workers in the United States. Fifth, managing your investment expectations and incorporating risk management strategies into your financial plan, of course, is always going to be important. And based on what's going on in the markets now and the volatility that we've seen in recent months, our team is encouraging clients to take advantage of this time and evaluate their concentration to these big mega cap companies and just consider focusing on quality names. Of course, we've talked a lot in the past few months about how top heavy the S&P 500 is. You can see it visually in this chart. The orange line here shows that the 10 largest stocks in the S&P 500 make up over 32% of the index, and we haven't seen concentration risk this high since the early 1970s. So yes, the S&P 500 may be nearing all-time highs, but that underscores the need to check your risk tolerance and your exposure to highly correlated companies. Thank you so much for joining us today. Please go ahead and hit the subscribe button if you're not yet subscribed to our YouTube channel, and I will see you again next month.